The next thing is there's a mortgage insurance premium. That's F2. Again, we want to think about if I'm the mortgage company, I'm always thinking I'm going to lend you $100,000, and I'm worried that you're going to move into that house and the next day, trash it, burn it, who knows what. You're going to just not make a payment and run away. And then what happens if I have to foreclose on you? I'm nervous. Let's say the house is worth $100,000 and you got a VA loan from me. And so I'm giving you $100,000 for this house. If you trash it, run away, I have to foreclose on the property, maybe, I'll have to get the property back, pay to fix it up, hire a real estate agent, pay their commissions and all the closing costs to sell it again. I'm not going to get my $100,000 back. No way. That's not going to happen. I might be lucky if I get $80,000 back. So I'm really nervous about that top 20%, that top $20,000. And so I'm going to make you pay insurance that covers me in case you flake out, disappear, and I have to foreclose on you and get the house back and sell it and I have to cover that top 20%. And so I'm going to charge you mortgage insurance. There you'll see F2 says mortgage insurance premium. There's a blank there. And then G2, it says mortgage insurance per month. There's also blank. The reason that they leave that blank is that mortgage insurance is charged 3 different ways. One way is if it's a conventional loan, they're going to charge you on a monthly basis. So it'll be part of your monthly payment. There'll be an amount, I'll say $100, okay, is going to be your mortgage insurance. And you're going to be paying that until the value of the mortgage is dropped to 80% of the value of the house, which, they'll calculate that, over time, they'll amortize the loan. They'll figure out once your mortgage gets down to 80% or less of the value of the property, that mortgage insurance monthly payment will disappear. Okay. If you're in a rising market, you might actually be able to get that to leave early if you have the house reappraised, a year or so after, or 2 years or 3 years after you move into it. If you're in a declining market, it may take longer. So, but anyway, a conventional loan has a monthly payment. If it's a VA loan, they call it, or the conventional loan will call it a private mortgage insurance. PMI is the term. If it's a VA loan, they're going to charge you an upfront fee. Typically, it's changed over the years, so I don't know the exact figure. You'll ask your loan officer, but it's about 3%. So if I buy a house for $100,000, I get a VA loan for $100,000. They're going to charge an insurance premium of 3% of 100 or $3,000, and it's going to be added to the loan balance. It's not going to be a monthly payment, but they're just going to charge a lump sum and give you a loan for $103,000. So approximately 3% more than the actual loan amount. They'll add the insurance premium on top of that. And that's going to be the VA funding fee is the name for that mortgage insurance. The third type of insurance is going to be through FHA loans. FHA actually does a combination of the two. They'll charge an upfront fee. Again, check to verify your numbers with your loan officer, maybe 1.5%. So about half of what a VA loan they'll charge upfront and add to the loan. And then they'll also charge a monthly fee, which is going to be about half of what the private mortgage insurance would be per month, so maybe $50 a month. So you might have a $1,500 added to your loan at the beginning and $50 a month. So that's why this form doesn't have exact numbers in there, because they're not saying what type of mortgage it is.